The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello, and welcome to this latest episode of the FedLife podcast. I am your host, Dan Sipe. If you're not a regular, I'm actually the founder of Serving Those Who Serve. And additionally, I am the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. I am going to begin as I always do, whether it's a podcast or webinar, by saying thank you. Thank you for taking the time to watch or listen today. And above all, thank you for your service. Government, to the country, to me, to everyone. In normal times, you don't hear that enough. You are definitely not hearing it enough now. And we understand that these are trying and even terrible times for a lot of our Fed folks. We are making sure that we are producing the content that you need to make the best decision possible, even if it's making the best of a bad situation. We want to make sure that you get everything that you are supposed to get. But again, thank you. You don't hear it enough, but you're always going to hear it here. The other thing you're always going to hear here is my buddy, Ed Zerndorfer, the guru, is back with us once again as part of our ongoing mission to reach, teach, and serve you. Once again, as is our practice, we follow Ed's FedZone articles. This is one more way that we can reach and teach. Some people like to watch and listen more than they like to read. So that's why we do it. Ed, it has certainly been a wild month for our feds. So it would be reasonable, certainly reasonable, to forget that this year actually began with some good news for our CSRS and offset feds with the enactment of the Social Security Fairness Act. And one of the big features of that act is a retroactive payment, which is great. Your article, though, has some valuable insights on how that might affect folks tax-wise. So set the stage for us on this.
Yes, Dan. Well, as you know, back in January 5th, that time President Biden signed the Social Security Fairness Act, took effect. And among the features of the Social Security Fairness Act is the fact that the two of the offsets that affect Social Security recipients, some Social Security recipients, namely the windfall elimination provision, the WEP, and the other one, the government pension offset, as a result, those two offsets were now no longer in effect. They've been around for over 40 years.
Sure.
And who does that affect? Who does it affect particularly? Someone, in case of the WEP, someone's receiving a Social Security check who is also covered by and receiving a pension in which they did not pay into Social Security. Example, myself, I'm a CSRS annuitant.
Indeed.
And I started taking my Social Security 4 years ago when I turned 70. And my Social Security benefit has been reduced, not eliminated, reduced about I've lost about 50 to 55% of it because of the WEP. Now, there are other CSRS annuitants out there, for example, and I got to emphasize, it's not just CSRS annuitants here. Any individual who worked for a state or a local government in which they got a pension from that state or local government, in which they also did not pay into Social Security. And there are a handful of states and cities around here. I'll give you an example. I know that the state of California, Texas, state workers do not pay into Social Security. We're talking about police officers, firefighters, teachers. They get a state pension. They didn't pay into Social Security when they were working for the state. They also are affected by the WEP. And the other offset is called the government pension offset, GPO. Now, who does that affect? That affects anyone who is receiving a pension in which they didn't pay into Social Security, but who's also not eligible themselves for Social Security. They didn't during their lifetime didn't accumulate 40 credits of Social Security in order to be what's called fully assured. But they're married to individuals, or they were married to individuals who are eligible for Social Security. And under the Social Security rules, when we have a married couple and we have both individuals eligible for Social Security, we have the higher earner and we have the low earner, or the no earner when it comes to Social Security. Then the low earner or the no earner is eligible to receive half of the higher spousal Social Security. It's called a spousal benefit. Or God forbid, their spouse is deceased, they get all their benefit. Well, under the government pension offset, the GPO, in this case here, the GPO, while it is a reduction to that spousal benefit, most likely it will be a total elimination, the way the formula is. So for most CSRS annuitants, and I'm one of them, my wife is covered by Social Security. I was not eligible to get half of hers because my CSRS pension is large enough, it wipes out any type of spousal benefit. Effective with the elimination of the Social Security Fairness Act, the GPO is no longer in effect. So Congress passed this law, and they made it effective, retroactive to January 1st, 2024. That was the effect. Even though the bill was signed on January the 5th, 2025, the law said it takes effect as of January 2024. So anyone like myself who was receiving a Social Security check, who was affected by the WEP, is eligible to receive a lump sum payment of what they should have received, the difference between what they got and what they should have received for the 12-month period, January 1st, 2024 through December 31st, 2024. Those are 12 payments that was made that were affected by the WEP, or for that matter, anyone who is receiving a Social Security check that was reduced and by the GPO or maybe eliminated. They also are eligible to receive a lump sum payment of what they should have received. Now, Social Security at first said, well, it's going to be a while before we can get those payments out. It might be in 2000, individuals may have to wait till 2026. But come February, February 25th, Social Security said, we did it. We were able to get these retroactive payments out, lump sum payments out starting in March. I got my lump sum payment in middle of March, and it was a lump sum payment of the difference of what I received and what I did receive and what I should have received, a lump sum payment. They also added, by the way, because they couldn't make it effect, they couldn't get the payments out until March. They said, well, it really will be also, we're going to add 3 more months, January, February, March, because my January, February, March payment did include the WEP. So they made it they made it for, I think, with 15 months worth of payments, lump sum payments. I got difference.
Which is great.
I was very happy. Okay. But with the lump sum payment comes
taxes.
A problem.
And you identify in the article, you identify 4 points in the article. So why don't you take us through those?
Yeah. In terms of, I mentioned the article, while Social Security beneficiaries certainly welcome the additional Social Security payments to be received earlier than initially projected, there are tax planning items here. Tax planning items to be considered for the year 2025. We're in the year 2025. Individuals are receiving these extra payments now, the lump sum payment and the additional. Now they're getting the correct amount of monthly payments. They're getting more money when it comes to federal income taxes. And here's my point: the additional taxes, the additional monthly benefit, as well as the lump sum payment that individuals are receiving, will mean additional federal income taxes. Why so? Many people are not aware of the fact that Social Security is taxable. Taxable. It wasn't always that way. It started 40 years ago. And it comes down to this. I'm not going to go into all the gory details. But for most individuals who receive Social Security today, given the formula, most Social Security recipients have to include 85% of their Social Security benefit, their monthly benefit. 85% of that will be added to their monthly income. And I didn't say it's being taxed 85%. What I'm saying is 85% of whatever the benefit is, that monthly benefit. Let's say it's $3,000, Dan. So what's 85% of $3,000? What, $2,450, I believe. So that $2,450 will be added to their other income, interest, dividends, wages, or pensions, IRAs, traditional TSP, whatever they're receiving. And then they're going to pay tax, whatever marginal tax bracket are. So if they're in let's say a 22% marginal tax bracket, they'll pay 22% on their taxable income. And that, including taxable income, is the Social Security. So now, as far as states are concerned, there are actually a few states that actually tax Social Security as well. A few states. So that's additional income that individuals have to consider when it comes to this new extra income coming in. All right, that's one thing. Additional monthly benefits subject to federal tax. And then we have something I call it the widow's tax penalty. As you know, Dan, I have I have a tax practice, and I go through this with some of my clients every year, unfortunately. I have a married couple, and they file jointly 1 year, and then one of the spouses dies. And we have, my case here, I have a widow or widower. And the year after the person dies, their spouse dies, that the widow or widower has to file as single, not married. The year that the spouse died, they can still file as married, filing jointly, but the year after, they have to file as single. As you know, Dan, single tax rates are different than married filing jointly tax rates.
Absolutely.
So now that we have a single individual, and if their income, the widower's income is going to increase because now they probably are getting more income for one reason. Let's say they're the beneficiary of an IRA, beneficiary of a retirement, a federal employee. We have his dies passed, so if the federal retiree dies and their spouse is getting a survivor pension, they're getting a survivor pension. That's going to be added to their income. Maybe they have their own pension, and they might be getting additional Social Security. When it comes to two individuals receiving Social Security with two spouses, and one dies, the other spouse will, if the deceased spouse's Social Security is more, they're eligible to get that. So now they're going to get more Social Security. What I'm saying is that the widower is going to have more income, but taxed at the single rate. It could result in what's called the widower's tax penalty. So I have to sit down with the individual and say, well, maybe you got to change your withholding, add more withholding, or may have to pay more estimated taxes. Unfortunately, a lot of people are not aware of this. I have some clients who don't listen to me. Unfortunately, they don't make any changes. They don't make estimated tax payments. And then when they file their taxes the following year, they have a big penalty because they didn't withhold them. They didn't withhold enough. I call it the widow's tax penalty. So that's another factor, another thing that when it comes to extra income, in this case here, we Social Security, and this lump sum payment that you're receiving.
Sure.
That's going to result in perhaps the individual, because I mentioned earlier that 85% of your Social Security benefit that you receive will be included in your income. Well, if someone's receiving a lump sum payment, this is the retroactive payment, Dan. Folks are getting $8,000 as lump sum payment.
Sure.
What's 85% of 8,000? 85% of 8,000 is about, what, 64, it's about 6,500 something? 8,000. It's about $6,800, Dan. 85%
Gotcha.
of 8,000. $6,800 of extra income. Now, Dan, do you think that may affect your taxes, getting $6,800?
Sure, especially if you didn't send quarterlies for it.
Yeah, and it could push you into maybe a higher tax bracket. It's possible.
Sure.
Well, I advise the individual, and I'm telling my clients now that if you got that lump sum payment, you better tell your accountant, that's me, that you got it and how much, because I'm going to see if you have to make what's called estimated tax payments. And yours truly is in that category. I had already made my first quarter 2025 federal estimated tax payment, and I added to that payment what my tax liability was on that lump sum payment I received. And finally, receiving that extra income, the $8,500,
Sure.
can have effect on this year's what's called stealth taxes. What is a stealth tax? It's a tax that sort of sneaks up with you and you're not aware of it. And I'll give you one example. I'm going to give you two examples. Something called the net investment income tax, NIT, that if your adjusted gross income is over $250,000, that any interest income you have, dividend and capital gain incomes that you pay regular tax, you're going to have to pay an additional 3.8% tax. That's the stealth tax, 3.8% on the tax that you're already paying. If you're paying 15% tax on your long-term capital gains, now you're going to be paying 18.8% tax on the capital gains. It's called a stealth tax. And the other big one, and this is the big one, if you're on Medicare Part B, what do you pay? What do you pay for Medicare Part B? It depends on your income.
Sure.
Okay. The higher your income, the more you have to pay for Medicare Part B. Your Medicare Part B premium every year is based on what your adjusted gross income was 2 years ago. So this year, anybody who's enrolled in Medicare Part B, like myself, my wife, we're paying, our monthly premium was based on our 2023 adjusted gross income. So what about this lump sum payment? What effect will it have for 2025? It will increase our 2025 adjusted gross income, that lump sum payment. Do we have to worry about Medicare Part B, the effect on our Medicare Part B premium? Not this year, not 2026, but 2027.
Sure.
So it's something that could happen it could affect someone down the line.
Absolutely. And folks, as usual, Ed writes great examples to help you understand this. This article is no exception. So again, head over to FedZone, fed-zone.com to grab the article. Again, treat it like your notes are pre-done for you. But in your example, you talk about Jason, Ed. So Jason has some things to do, right?
Yeah. If I could just quickly go through the example, just read it.
Please
quickly.
do. Yep.
Okay. So Jason's 73 years old. Okay. He's a retired federal employee. He entered federal service in 1974 and worked 36 years before retiring in 2010. He was covered under CSRS and therefore was not covered by Social Security. But after he retired from federal service, he earned a minimum 40 credits of Social Security. He got his 40 credits, thereby becoming fully insured, and he was eligible for Social Security. Now, he did not start receiving his monthly Social Security benefit until 2022 when he turned 70 years old. Why so? Because he got an enhanced benefit. He waited past his full retirement age 4 years to receive his first Social Security check. He got a 32% bump in his payment. Okay. But he also knew, because he was subject to the WEP, he was going to lose part of his Social Security. He lost about 50%. He lost about 50% with the 32% vote, the 32% bump. He came out not that bad. He really lost about 20%. So his Social Security benefit was reduced by $550 per month. $550 per month. And it stayed that way. We're talking about 2022, 2023, and 2024. With the passage of the Social Security Fairness Act, he's no longer affected by the WEP. So, bottom line is the retroactive benefit, Dan, the retroactive benefit for the resulting in Social Security benefit, he receives a check for $7,700 on March 7th, 2025. Okay? Now, what Jason has to do is he has to meet with his accountant to go over that. What effect the $7,700 is going to have on his taxes?
Sure.
If I was Jason's accountant, here's what I'd tell him to do. For the first quarter of 2025, you have to make a federal estimated tax payment. And he says, well, how much do I have to make? Jason, you're in a 24% tax bracket. I determined that. And you'll be that way for 2024, 2025. What's 24% of $7,700? It's about a little less than $1,900. Jason, you're going to make an estimated tax payment, the IRS, of $1,900, and you'll do it before when? April 15th. That's the deadline. Oh, why can't I do it later in the year? I heard you can make estimated tax payments anytime. Yeah. But IRS wants its money now. They don't like to get paid later. Because what's going to happen, Jason, is that if you make that payment later, they're going to make you pay a penalty. What type of penalty? Because you didn't pay them when you first received the income. Understand? Everybody says, well, I heard that if I pay in 90% of my liability during the year, for when it comes to withholding, I reach 90% of my annual tax liability, in this case 2025, I won't be subject to a penalty. That's not true. What the 90% means, you have to be within, your withholding has to be within 90% each quarter of the year, not for the whole year, each quarter. We are in the first quarter of 2025. Jason has to pay in through withholding and or estimated tax payments 90% of his tax liability for the quarter ending March 31st, 2025. When did he receive this payment? I mentioned March 7th.
Gotcha.
So he has to make that estimated tax payment, or else he's going to be subject to an under withholding penalty when he files his 2025 taxes next spring. I cannot tell you, Dan, how many times I preach to my clients. Don't pay that under withholding penalty. You're throwing money away because you can avoid it. I hate IRS penalties. The reason I hate them is because you can avoid them. I didn't say evade them. I said avoid them by doing the right thing, by paying those estimated tax payments. So anybody out there who might be listening to this podcast now, or maybe a little bit later, before April 15th, if you got that lump sum payment for lump sum annual leave, you call your accountant and mention that. If you had not told your accountant, because you may have to pay that estimated tax payment. And if it's after April 15th, then do it during the second quarter. Because the longer you wait, the more penalty you're going to pay.
Gotcha. And Ed, you kind of round out by encouraging our effective feds to be proactive. What does that mean?
Proactive, that monitor your taxes throughout the year. In terms of, you're going to get additional income somehow. You win the lottery, or you make a sale of a capital asset. You have a brokerage account and you sell a stock, a mutual fund, and you get a huge gain. That's wonderful. You got a gain, but you should definitely tell your accountant that something happened during the year. Something happened that's going to drive up, that's going to increase your tax liability. Let your accountant know so your accountant can tell you what to do. Don't tell your accountant next spring when you bring in all your 1099s and things like that, and your accountant says, what is this all about? Oh, I sold something in a game. Why didn't you tell me? You realize you have a huge tax liability? Don't let your accountant be surprised. You got it. When it comes to tax planning, Dan, in general, tax planning occurs throughout the year. It's not done in the spring after the fact. Because unfortunately, people find the hard way that they're going to be subject to penalties, under withholding penalties. Like I said a few moments ago, those under withholding penalties, in which you have to pay interest. And the interest is it's like 8% now under withholding penalties. 8% that you didn't pay in enough throughout the year. It's money thrown away.
Gotcha.
You can avoid that penalty by being proactive. Make sure your accountant works throughout the year. That's what I have to say.
Couldn't agree with you more. As usual, great stuff, brother. You did it again. You took an important and, dare I say, complicated topic and made it accessible for folks. So we hope you benefit from this. All of our CSRs and offset folks who had the happy news of the weapon, the GPO going away. Let's make sure that there's not a salty taste at the end of that. It came in sweet. We don't want to be like Sour Patch Kids. So folks, please share this information with your friends and colleagues. And Ed, as per usual, thank you for being such a great resource for our feds.
Most welcome, Dan. I'd just like to add one more point for those individuals who were supposed to get a lump sum payment. They were supposed to get it by March 31st, but had not. I encourage them to contact Social Security, to find out why you did not get that lump sum payment. Again, if you were eligible for it and you didn't receive it, and you didn't get it by March 31st, please contact Social Security about that.
Gotcha. Nope. Great stuff, folks. Folks, that is a wrap. We are serving those who serve. So be sure to subscribe to this podcast. Hit that subscribe button, folks. Then it's just going to be coming to you. You don't have to go looking for it. You never know when Ed's going to have unbelievable nuggets. It's usually pretty much every week, but you don't want to miss out on that. Please remember to share it with friends and strangers. And don't forget those live webinars every single week. Just go to the SWS website. You will see the webinar button. Click on it. You'll get the whole menu. And yes, that means the guru will come to you, reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Share with your friends. They will thank you. Be sure to read Ed every single week with FedZone. That's fed-zone.com, because we only amplify 2 of those articles. So that means there's some real gold out there that if you're not reading it, you're definitely missing out. So signing off for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, signing off as I always do by saying good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.